Okay, well, let's do it because we have so much to get into and we're really, really excited about this conversation today. It is my pleasure to welcome each and every one of you to what we know is going to be a very insightful conversation. It's a very important conversation for many in our community with William Lieberman of the CEO's Right Hand, and also his guests, his amazing panelists who he will introduce at more length. Before we dive into that conversation, just a very brief word about the Fourth Effect. For those of you who are not already inside of the Fourth Effect, part of our community, engaging with us, I just want to share what we do. We are equipping startups and scale-ups to build and leverage fit-for-purpose advisory and governing boards. And then we are matching them with game-changing advisors, board director candidates, and investors so that we can really help those startups scale smartly and effectively. So for executives, we are a unique gateway to break into the board pipeline, gain valuable advisory experience, and really step into the world of early stage investing. If you have not started your 30-day trial yet, you are a founder of a company, you are an executive, you are an investor, please consider joining us for a platform tour. We'll share the link in the chat. We do these twice a week. It's just a great opportunity. It's good networking in its own right, but to see us in action and really understand the value prop, figure out if this makes sense for you, and live onboarding, it's easy to do when you're there. So recommend that you do that and consider joining us. We're really an incredible community. And I guess the last thing I would say about that is just not only are you matched to opportunities, but you really have the ability to proactively search and filter. And this is true on both sides of the marketplace. So really encourage you to engage, join us. We'll also share the link for Board Bootcamp. We do this every 6 weeks or so. We have one coming up in May. It's very substantive. It's also a great introduction. And if you are a member, it's great to make sure that you sign up and come to this because we really recommend all members do attend a Board Bootcamp within the first 3 months of membership. If you've attended in the past, you haven't come in a while, there's a lot of new materials and updates. Encourage you to swing by again. And we'll drop some other stuff in the chat as well. We have some other great programming coming up that we will share. But let's get to the point of today. We could not be more excited to introduce William Lieberman, founder and managing partner of the CEO's Right Hand, a partner to the Fourth Effect. So William, I would love to hand the stage over to you to just fully introduce yourself and also your incredible panelists.
Great. Thank you so much, Breen. And it's great to be here. It's great to be a new sponsor and partner of the Fourth Effect. And it's going to be an interesting series. We have a great session today and a couple more coming, which we'll talk about. So I'm going to go over to my presentation here. And it's all about capital raising. So what does that mean? How does it work? And what are the types of things that small, early stage growth companies looking for capital need to think about? And so what are we going to do on this session is talking about how do you prepare for capital raise. So about us real quick, we are a finance and HR consulting firm. We sell services to small and medium businesses, early stage growth, of course. We've been doing this for about 10 years, based here in New York, but we have clients and staff all over the country. It's virtual business. And we have very tailored solutions and very affordable solutions, again, for that early stage growth company. Our team has been doing this for many years, both as part of the CEO's Right Hand platform, as well as on their own. And so our team has tons and tons of experience raising capital across all sorts of different types and flavors. So it'll be interesting for you to hear directly from one of our team members, Kim, and we can go into all sorts of details. We have 3 parts to the series. So today is preparing the company for investment. And then the next session is going to be in a couple of weeks. That's building your investment case. And then the third session is closing the deal, which is all about executing and negotiating the best possible deal that you can. So those are the upcoming sessions, and we'll remind you about that when we get there. So for the panel today, I'm pleased to have Laura Chung, who's a Fourth Effect advisor, and Kim Petry is one of our CFOs. So Laura, why don't you go first? Just say a quick hello.
Hi, everyone. Glad to see you here. I am a strategic advisor. I help early stage startups, and my experience is in transformation, helping growth, primarily in financial services and fintechs.
All right, Kim.
Hi, my name is Kim Petrie. My background is CFO space at Fortune 100 companies, but for the past 8 years, I have been working with startups from seed to sales. So I do everything all the way on up the chain. So pleasure to meet you all today, and I'm looking forward to speaking with you.
Awesome. So we're going to do our first poll question just to get things going, make sure everybody's awake. So are you looking to raise capital in the next 6 months? So there's 3 choices. Yes, we have some serious growth plans, so we definitely need to raise some capital, or you're not sure if you need it or not. And no, we're not ready, or we have enough capital now. So let's go ahead and get that poll going, Mercedes. We'll give everybody a few seconds to do that.
Yes, a lot of people looking to raise capital.
Now I'm looking at my presentation, so I don't see the results. So Kim, if that was you, can you just summarize what we got?
Well, I don't have the summary, but I'm watching all the hands go up, the thumbs up hands.
Mercedes, do you have the results there?
So we have so far 10 votes on we have serious growth plans, 1 vote on not sure if we will need it or not, and 1 vote on we're not ready and or have enough for now. So about 10 people have voted. We have serious growth plans, which is awesome.
All right, so you're in the right place. So I'm going to hand over the mic to Laura, and she's going to talk about the current landscape for capital raising. And Laura, just as you need, tell me to go next, and I'll get the next slide for you.
Okay, great. Thank you. So let's talk a little bit more about what the current landscape looks like. If you go to the next slide, please, William. We'll look through women-led companies that are raising capital. We'll go through the funding reality, progress, the different channels that you can actually have, and what are some of the sectors that women are finding companies in and being invested in. Next. Now, this statistic may not surprise many of you, and that is that only 40% of businesses are owned by women, and only 2.3% of venture capital funding is actually given to women-led startups. Okay, next. Now, there is positive news behind this, right? And there are funds that are specifically focused on women entrepreneurs. There's been players that you probably heard of, How Women Invest, Female Founders Fund, and Halogen Ventures, that have been addressing this large gap that we see in VC funding. Many of these there's a lot of new funds that have been created, and just in the past 5 years alone. And you can see them in the tiny 4-point font at the bottom that are there. This is an eye test for everyone. But if you see above the line, you can see in the past 5 years, many of these funds have started. Some notable examples are January Ventures, which you may have heard about. They were actually used to be known as Jane VC. And this is a focus on really backing women and underrepresented companies or founders at the earliest stages. And going all the way through some other notables, you have Graham and Walker. They were formerly known as Female Founder Alliance. They were actually a community, and they turned into a venture fund in 2021. So you see some of this happening organically, all to try to really help women. You also have the Rise Up Fund, which was launched in 2022, and they focus on seed stage investment in women-led enterprises. And you also have the 22 Fund. That was founded earlier. I think it was about 2018, if my memory recalls correctly. But what they have done is they've grown substantially in recent years, with their focus on being on women and the BIPOC-owned businesses, which is the Black and Indigenous people community. I don't want to bore anyone with going through all the details, but this is a great time for you to take a screenshot, because I saw many people putting their thumbs up about how they're looking for funding. This is a great place to start, is to research some of these companies that are actually investing.
And we will circulate the deck as well.
Okay, great. Next, so there are alternative channels as well on top of this, right? The first one being reward-based crowdfunding. If you're not familiar with this, this is actually where it's a method where backers contribute funds for non-monetary rewards. So in other words, early access to a product or merchandise. Great examples of this are Kickstarter or Indigo, where they offered individuals pre-orders for a new gadget. Okay. Another example is equity crowdfunding. And this is really raising capital by selling shares of ownership to a large pool of investors, often non-accredited investors, where investors will receive equity in proportion to their investment. So an example of this would be a tech startup offering 1% of equity to a group of 100 small investors via a platform like Seed Invest. Okay. Another channel is community-focused funding. And this is where capital comes from organizations like the Community Development Financial Institutions, where they prioritize underserved communities. And these funds support anything from local businesses to affordable housing or social impact. And you've got grant programs. And grant programs are non-repayable funds from government agencies, nonprofits, or corporations. And they help support specific initiatives like innovation, diversity, or community development. And you've got some examples there along the way. And lastly, there's revenue-based financing. This is where capital is provided in exchange for a percentage of future revenue. Okay, so until a predetermined multiple is repaid. So there's no equity or fixed payment required, right? This is another form. And when I hear this is an example of a SaaS company paying 5% of monthly revenue to investors until $150,000 is repaid for a $50,000 investment. So to kind of put this in everyday terms, if you think about Shark Tank, you'll hear this type of offer offered several times by Mr. Wonderful. That's how I think about it.
So Laura, quick question. How would you suggest somebody think about getting either VC money or one of these alternatives?
That's a great question. I think a lot of it depends on their maturity level of their company, what stage are they at. I think the second also is thinking about how much are you willing to give up of your ownership of the company, right? Because you'll be giving up a lot more equity in some of the alternative channels or versus the VC channel.
Okay.
Now, we have different sectors here as well. And where you'll see is funding varies based off the sector. And you'll see the higher percentage is really coming in in healthcare with 21%, followed by consumer products at 18%. Now, you might wonder why healthcare or why is it such a high percentage? Part of the reason why there was a higher percentage of women in funding in these areas is the healthcare sector has quite a number of women professionals in that area. But most importantly, as a woman, what I see is we have unmet needs. And that has been a call to action to women to start companies to address those needs, right? Yes, Johnette, that's what we're doing. And that's what you'll see a lot of is we see problems and we jump right into it and say, you know what, if there's not a solution, we'll help fix that, which is fantastic. You'll also see something very similar in consumer products and goods because, you know, that is where women are leveraging their own personal experience to create innovative solutions along the way. I see Maria nodding wholeheartedly, so I can't wait to hear, Maria, what your business is along the way. Now, if you happen to see your sector and it has a smaller percentage, do not be discouraged by that at all, because part of what William and Kim will be walking you through later, and myself as well, is how do you beat the odds? If you weren't one of the individuals to beat the odds, you would not be a founder with that persistence, right? So let's talk a little bit about common challenges, right? There's some common challenges that you may face, and we're going to help you prepare for that. One is unrealistic expectations. right? Not understanding what your goals are and the process of raising capital, or having an unrealistic valuation assumption, okay? The second one, which is near and dear to my heart, is lack of readiness. To me, if you're prepared, it takes a lot of the angst out of things, right? And this is something you can actually control. You can control how prepared you are. So this is something to really be thoughtful about, because investors, and I'm an angel investor, we can tell if you're not prepared. Right? We just have a sixth sense for this. Okay. A third common challenge is a poor financial infrastructure, right? You can't build a scalable business if your back office or your plumbing, how are you receiving income, how are you making the payments, is not scalable, especially when you're growing. And many of you are in a growth phase. And Kim will talk to us later about how do you ensure you have the right financial infrastructure. Okay. And the last thing, common challenge, and there could be others, but the last one is really not having a clear growth story. And this is another area where I see women can truly excel, is telling the story, right? Sharing your vision, like, why did you come into the space? What problem are you seeing, right? Where are you headed? And bringing investors in. If you can bring investors in, they'll be willing to open up their pockets and invest in you, if you can tell that story. Okay. Next slide. Right. So let's talk about the first one, which is setting clear capital raising goals. Okay. So with this, the first step is really determine what your capital requirements are. Right. You need to calculate a precise funding need based off of your detailed financial projections. Okay. We advise that you include a buffer of about 25 to 50% for unexpected challenges. You did not realize that you'd have flooding occurring, or your computer crashed, right? Or on a positive note, opportunities. All of a sudden you have a tremendous amount of growth. How are you going to meet those needs, right? The third on determining capital requirements is align your capital raise with clear milestones that will create a demonstrable value for each step. Okay. The second thing to think about is identifying the appropriate funding type by the stage of your company. Where is your business during this growth? Right. So if you think about, if you happen to be in a so if you think about the funding stages, there's pre-seed and seed, there's Series A, and then there's growth in Series B plus, right? If your company is at the early stage where you're thinking about, I have an idea, I need market research, I need a prototype, I needed to come up with a product and develop the product of what I'm actually trying to build, right? Pre-seed, which is your friends and family, your angel investors, your savings account, crowdfunding, would be a good match for you, because this group is more willing and flexible to take chances on ideas that aren't fully formulated yet. Okay. The other stage would be Series A, where at this stage, you have a minimal viable product. You have something to really see. You're looking for capital to scale your operations or optimize your business model and have better efficiency in what you're doing. For this group, a Series A might be a better target for you. A Series A would be your angel groups, your early stage VCs that we spoke about, or a strategic partner. Your third stage would be your growth stage. You're kicking it. Your product's out there. You're growing so fast. You need to expand. You need to bring on more people to help accommodate that need. That's where growth or Series B plus, which will be like your institutional VCs we spoke about earlier, or your private equity, or your strategic investors, would be a better market to go for, or a better target group. Okay. Your third thing is to really define what your strategic objectives are. What does that mean? What are you going to use the money for, right? And that's what investors are going to really want to know. And if you think about what your strategic objectives are, that is really going to be your roadmap, and it will help you prioritize what decisions, where should you focus on based off the money that you raise. So those objectives are your anchor, and they serve as a way to define a roadmap. Now, these objectives could be in three categories. One could be product development. You need more R&D. You need to prototype more. You need to test more. You need to get your production in place. It could also be in market entry. You need a sales and marketing team. You need distribution channels, and you need to invest the money there. Or you need to hire individuals for the marketing to get into the market and penetrate areas that you may not be in. The third category is scaling, right? You may need to expand your team. You need to hire a full-time CTO. You need a COO or chief operating officer. You need someone to also run your marketing. It could be a variety of team members. It may be scaling to new markets, or it could be improving your infrastructure, right? Whether that's technical or whether it's financial along the way. The last thing you really need to think about is when you set your capital goals is also consider exploring non-dilutive alternatives. In other words, are there government grants that are specific to women-owned businesses, like an SBA, for example? Are there revenue-based financing options that you can go with? Are there strategic partnerships with larger companies? Like if you're in fintech, for example, Barclays Capital invests in fintechs, right? Another one that's a very creative way to think about is competitions, right? Competitions are pitch contests where cash is the prize, right? Not only do you receive practice in your storytelling, but you also get practice and you get valuable practice, but you get valuable customer feedback coming and feedback from investors as well from the competitions and pitch contest. And you also get to meet other people. I'm an extrovert. I like that one appeals the most to me because it's the most fun in my mind.
Great. Thank you. Perfect. Mercedes, are there any quick questions that you see there?
Not at this time.
Perfect. All right, let's keep going.
You know what? There is one question. I just didn't have the capable queue. How should founders think about their valuation when valuation is an art versus a science? West Coast investors typically are more comfortable with higher valuations, for instance. Any guidance for early stage founders trying to determine the right valuation?
Yeah. So there's a section of this presentation about that. So we'll get to that one. That's
Excellent segue.
We'll get there. That's a great question. All right. So Kim, can we talk about what it takes to get ready for a capital raise?
Absolutely. So in order to go out and raise capital, you really need to be sure that you have everything intact before you do so. I tend to inherit clients that are not mine. I end up inheriting them that have not done every step. And I can tell you that when you do not take the steps and try to go out and raise capital, I think Laura alluded to it earlier, is investors know. Right? So you think Shark Tank, like Laura had mentioned earlier, the investors, the founders who basically know their numbers, know their business inside and out, tend to be the ones that basically get funded. And by that I mean they know every aspect of their business. The ones that fumble, can't really speak about their numbers, don't understand metrics and so forth, are the ones who tend not to be successful. So a lot of the work we do in advance of any kind of capital raise is really getting things together, getting them ready such that we are ready to face appropriately investors that we can basically support our position in terms of whether it be our valuation, our financials, or our entire overall business, right? So the first few things that we take a look at are a market validation assessment. So we really tend to look at where you stand in the market, what your competitive landscape looks like. And then to Laura's earlier point, when you're coming up with a valuation for your company, it really has to be in the appropriate range. You know, if you want to take a good look at a good case study of an incorrect valuation, WeWork is a good example of a valuation that went out at an incorrect amount and he did not get funded, right? And that's a huge company, right? Like, so getting that valuation correct up front is really pretty critical. Next piece is team evaluation. I'm going to talk to you a little bit about the finance organization, but overall, in terms of your team, as you grow your company, needs change in the company, right? So when I even look at things like accounting and finance, the individuals that maybe start with the company are are great, but may not be able to take you up to the next level, right? So evaluating the team, understanding what talent you have, what that talent is capable, what their experience is, and are they able to take you to the next level or maybe not, right? Because they might not have that. Assessing the landscape, assessing your team, and really figuring that out. The next piece is your competitive landscape, right? So who are your competitors? Who are your direct competitors? What space are you sitting in, right? And who is in your space? So you have the large competitors out there usually, but then also the smaller competitors that are on the up and coming. And what do they have and what are they offering? And what is your value proposition? Why should a customer pick you over a competitor? And those are things that you really need to be able to articulate appropriately as to why basically our company is a better selection than another company. So what are your value propositions? What are the benefits of using your organization? What are your standouts are really incredibly important. Business model and clarity and visibility. So one of the things we do with any kind of company that wants typically put together a very detailed 3-year business model. Now, Laura mentioned earlier about coming up with that strategic plan, right? But as part of that strategic plan, essentially, we want to have a really solid financial model that goes through not only just a P&L, but what are the drivers behind your business? What is driving your revenue? What is driving your expense? How does that scale in terms of the financials? What does that look like in terms of profitability? And really have all of the assumptions and details available. And not only that, but also be able to articulate that information to investors. Investors want to see that you have a well thought out strategic plan as well as a well thought out financial plan over the next 3 years that you can articulate essentially what direction the business is going, what revenue are we driving, and what are the drivers behind that revenue? So not just that we're going to grow a revenue amount over the next 3 years, but how are you doing that? What are the drivers behind it? What are your risks? What are your opportunities? What does that look like? Where are the pitfalls? And that you've clearly thought that out. Typically, the business model also includes things in terms of a base case, so where you really think you're going to be, but then what is the worst case scenario? And if you hit a worst case scenario, what is your action plan to make sure that you stay on track? And we also do a best case scenario usually to say, if we can drive more growth, what is that going to look like? And what are the drivers behind it and so forth? So having that business model put together is really critically important. But then having the detailed drivers behind that model and being able to articulate what's driving your business is key. Regulatory and legal readiness. So depending upon your business, regulatory is incredibly important. So depending upon what business you're in, you want to make sure essentially that the regulatory boxes are checked off, and that includes things like taxes. I inherit business all the time that say, well, I didn't file my taxes. Well, that's a problem when you're going to raise capital, right? And I see that a lot of times in small businesses, right? Do you have all your tax in compliance? Do you have all of any kind of regulatory needs in compliance? Because that's not something they're going to ask you about. You usually include that actually in your data room, that we're compliant on the regulatory front. And then financial data availability. So I'm going to talk to you in just a little bit about the financials themselves, but investors want to take a look at financial statements that are in good working order, that are clearly understood, and that are GAAP compliant. A lot of times small startups will run on cash, and cash is incredibly important to a young business. However, your financial statements need to be GAAP compliant because an investor is not interested in a cash-based financial statement. And when I mentioned financial data availability, that also means things like a balance sheet, not just your P&L, a cash flow statement. What is your trends and metrics and so forth? So it's really having the financial data in good form for your company and having that available to your investors, not just a snapshot in time, but what it looks like over a period of time as you built your company, and then being able to explain that story and what those numbers mean as you go. If you want to move to the next slide, please, that would be okay. So what does that entail, at least from an accounting finance perspective, right? So what that includes is what people commonly refer to is a strong financial infrastructure or your tech stack in finance. So the first aspect of it is, do I have a good accounting system in place? And a good accounting system can be something as simple as QuickBooks. I had a $300 million company sold to Nike that was still sitting in QuickBooks, and it was totally fine. By the way, Nike used that for a year before they integrated into their systems, right? So essentially, you want to make sure that you have a strong accounting system, but not just that, okay? The accounting system is important, but then what are the other aspects that you're using to basically do payments? Is it automated? Your invoicing, is it automated and is it scalable? Any kind of payments that you're getting, what can we connect? Can we make efficient? And the reason for this is incredibly important. You want to make sure your finance tech stack is scalable. All right. And I'll give you an example. I know somebody who tried to sell a business that was a good sized business. We're talking close to $1 billion business. Okay. So you're talking about a big business. They couldn't sell it because their invoicing process required about 100 people to do the invoicing. It wasn't scalable. So every time they took on more invoicing, they threw people at it. Okay, that's not a scalable solution. So in order to be able to raise capital, an investor will look at that pretty negatively. So you want to make sure that those financial systems are streamlined, that they're integrated, that they're functioning properly, and that we can scale those systems as we go and add in growth, that we don't have to keep adding headcount to send out invoices or adding headcount to do a certain task. So your financial system is really the foundation, and I call it the financial tech stack because it's not just your accounting system, it's everything else flowing into it. That is the key to the foundation. The next piece is your financial management team, right? So a lot of people will say to me, well, I have a bookkeeper. And I'll say to them, that's great. They do bookkeeping. Bookkeeper doesn't understand accounting. Okay, so I'll give you an example. I inherited a company. They came to me after they went to raise capital. I didn't know them before. And they said, I don't know what we did wrong, but they're telling us our financial statements are not good. So, and we have a bookkeeper and they're doing the work. And nobody's interested in investing in us. So I took a look at their financial statements, and yes, their bookkeeper was reconciling everything, but their bookkeeper did not understand what cost of goods sold really was about, that they needed to use an inventory costing method, that they needed to consistently apply cost of goods sold, that there's things like prepaids and accruals and stuff like that in accounting, that there's this accounting overlay. Right? So although you might have a bookkeeper that basically is doing your books, are you really doing the proper accounting on your books? Are things consistent? Even though they're reconciled and they agree to the bank account, that doesn't necessarily constitute your accounting. So taking a look at your financial management team and saying, do I have the right people in place? And it doesn't have to be full-time people, right? In many of the clients I work for, we have a fractional bookkeeper, we have a fractional controller, we have a fractional CFO, because we understand that cost is very important to a small company. But the financial management team is critically important because a bookkeeper can't do the same thing as a CFO, right? A bookkeeper is going to do their reconciliation and be done, but you need to make sure basically your financial management team is sound and that you have the layers of it to basically make sure there's oversight on all that you're doing. Reporting and analysis capabilities. So if we essentially produce financials, are we able to analyze them and gain data out of them? Are they proactive versus reactive? And I like to always use our financial statements from a proactive standpoint to say, essentially, what are we doing on a monthly basis? How do we course correct if we need to course correct? What are things we want to change? Because especially in a growing business, things change all the time, right? Direction changes all the time. Growth trajectory, if you see yourself bringing in a ton of growth, things change, right? And so essentially, we want to make sure we have not only the reporting and analysis in place, but that we're using that reporting to be proactive moving forward.
Hey, Kim, I apologize. I just want to be cognizant of time. So I know there's a lot to go through, but you're going to need to accelerate.
Sure, no problem. I apologize. Internal controls. Why is this important? Okay. I just mentioned to you, I sold a company for about 300 million to Nike. If we didn't have control documentation in place and good internal controls, and by the way, that company went from 0 to 300 million in 2 years, right? So if we didn't have those controls in place, Nike wouldn't have even talked to us. So as you start to come up the chain, making sure you have really good documentation in place, that there's processes and procedures, and that internal controls are well thought out, because that matters to investors. And as I talked about previously, the technology stack is incredibly important when it comes to your financials. We can move forward. Okay.
So just go through this quickly.
Sure. Developing your growth story. Okay, your growth story is everything, right? So you need to be able to articulate the vision, demonstrate how you're going to grow and what the drivers are behind the growth, how you're going to showcase your opportunity. So as I mentioned earlier, what differentiates you from other competitors, right? And then being able to explain from a financial perspective, what are my growth levers and what are they going to do for the investors? Okay, so how does that play into the economics of your business? And then avoiding potholes. Okay, so you want to be able to address any kind of risks or any kind of concerns that an investor have, and well thought out up front, such that when you're sitting in front of the investor, you're able to address any kind of concerns they might have going forward. You can go forward. Okay, so financial fundamentals. Okay, I mentioned to this earlier, I'll go very quickly through this. Your accountant is not your CFO. There's a difference between a bookkeeper, an accountant, and a CFO. And there's also a difference between a tax professional, right? So tax people, just because you have a bookkeeper, that doesn't mean they know taxes, right? If you have an accountant, that doesn't mean that they basically know strategy, right? So there's different roles that these individuals play. A bookkeeper does your day-to-day, whereas your accountant will overlay the accounting. A CFO can overlay the accounting, but then they also focus on strategy, pricing, investor relations, raising funds, what direction the business is going to go, and how we're going to scale it. We can move forward. Yep. Okay. Other thing really important, and I alluded to this earlier, cash versus accrual. A lot of small businesses run on cash. I completely understand why, right? Cash is your biggest concern. You don't want to run out of cash, but a cash-based financial statement is not going to fly with investors. Investors want to see that you have GAAP compliant financial statements, that you understand the discipline of accounting and you understand how that flows through. Laura, you can correct me if I'm wrong, but I've never seen anybody funded on a cash-based financial statement. It just doesn't happen, right? So most of the time they want to see that you have solid GAAP financial statements in place, that you understand accruals and prepaids and accounting policy and GAAP overall, okay? So we also will track the cash, but the GAAP financial statements are really very critical. Okay, so I mentioned to you earlier, putting together a financial model. It's usually a 3 to 5 year model. Okay, the key with that financial model is we're going to do a very detailed view of your profit and loss statement, but not only include your profit and loss statement, we're going to develop the key drivers that are behind that financial statement and be able to articulate and understand how those drivers and levers affect your financial numbers. It should be very clear to any investor what those drivers are and how they're influencing your overall income statement. Essentially, as I mentioned earlier, we have a lot of what if scenarios. So you also want to run that model once you have it in really good form. In the worst case, like I mentioned previously, so what are we going to do if the economy implodes, if volumes don't come in the way we anticipate, and so forth? We want to have a plan for that. And then we want to have a plan for if things come in brilliantly and we have extra money. So where do we want to deploy that? Where do we want to build next? Because as mentioned previously, Laura mentioned the investor wants to know where you're spending your money. Typically, these financial models, any extra money that are coming in from investors, they really don't like to hear that it's going to be for my day-to-day expenses. They want to know, what are you going to do in terms of growth and building? Right? So am I building out a platform? Am I investing in advertising and salespeople? How am I going to make this business grow? So they really want to be able to see and take a look at where that money is being spent, and it really needs to be poised towards growth. Okay. So
KPI. So I think Mercedes, we'll just do a quick poll. Do you have key performance indicators for your company? So of course, I love KPIs. I think so, but I'm a little fuzzy on them. Or, I've never heard of them before. So a few more seconds, and then Kim, you need to do this one really quickly.
Sure. All right. Key performance indicators. Okay. So if you don't have them, they're really critical as part of this capital raise process. And what they are is basically your key performance indicators. They focus on relevant metrics that are relevant to your business. So there are some key common ones, like things like net income percentage, gross profit percentage, revenue growth, right? Those are applicable to every business. But then depending upon what industry you're in, you want to develop clear, concise, key performance indicators that basically tie into your financials, and they really need to be centered around the items that drive your business, that drive your profitability, that drive your revenue. They need to be measurable, and we need to be able to measure them against what our planned KPIs are going forward. Another good way to look at it is there's also industry benchmarks for several of these metrics. So depending upon what industry you're in, you can look up the industry benchmarks. But essentially, you want to develop clear, concise, and crisp metrics that support your business and the growth of your business. What investors look for, things like how well your revenue. So one key thing, I'll give you one key stat. A lot of, in terms of when we look at growth, right? If you take a look at the revenue growth plus the net income growth, if it's over 40%, typically that's in a really good space to get funded, right? So if your revenue growth plus your net income growth is over 40%, investors love those type of companies. Okay, so that's one metric. Other metrics are like things like your gross profit, net income, and so forth. This is a sample essentially of a KPIs that's an investor-ready dashboard, right? So we typically will build dashboards for our companies, and they're able to measure this usually typically on a monthly basis and report out how they're doing against their KPIs. And then things like this is a SaaS company KPI. So things like MRR, monthly recurring revenue, ARR, LTV, TCV, total contract value is another one, churn rate, things like that. So this is just industry specific for SaaS, but depending upon your industry, it's easily obtainable in terms of what your metrics are. And then some of them can be custom to your company as well.
Awesome. Sorry to
No, it's okay. I talk. So.
All right. So let's talk a little bit about valuation and what that involves, right? So when you're an early stage growth company, valuation, and the question was even mentioned this, it's more of an art than a science. It's really difficult sometimes because you're so new. There's not a lot of data upon which you can draw a real clear-cut value for the business. There might not even be comparable companies. There might not be transactions that are like yours. So what we have to do is really look at a few variety of techniques in terms of how do we put this together. And there is some math to that, but a lot of it is, an art. You have to think about what are the factors that can affect valuation, and we'll talk about that in a second. Most people don't understand that there's a pre-money and a post-money valuation. Pre-money just simply means how much is the company worth before the investor writes that check, and then the post-money is after the investor writes a check. So if your valuation before the investor comes in is $2 million and they write a check for $500,000, then the pre-money is $2 million and the post-money is $2.5 million. That's important because when an investor makes an investment, they're going to ask you, what valuation are you looking for? Valuation is critical, but there are other factors that are very important to consider. Things like liquidation preference. And we can talk about that offline, or if you have any questions, there are a bunch of terms on a term sheet that you need to understand. And there's some complications to it, but once you go through it, and you see it sort of written down and spelled out in let's say a spreadsheet, if it's impactful on a numbers perspective, you'll get it. And then dilution. Dilution is just how much of the company are you giving up when that investor comes in, and ensuring that you have enough so that when you hire your next C-level executive or more employees, or they need stock options, you have enough left in the pool, so you're not giving the investor and giving your employees and giving all these other people equity, and then you, the founder, end up with hardly any at the end. So dilution is very important. So things that increase value, right? If you have a recurring revenue model, your subscription business, those contracts just flow and the money flows every month, every year, that's very valuable, and an investor will give you the impact of that in terms of the value that they give the business. If you have a solid team in place, they've done this before, they've grown businesses and maybe they've exited businesses before, or they've worked together before, that's helpful. You have traction and you can prove it, right? Here's what we've done so far, and here's the data that backs it up. So here's the growth that we've achieved. That's helpful. Having that growth potential, and Kim and Laura both talked about this, making sure that you have a business that has significant growth possibilities. So if you get that capital, how are you going to put it to use? How are you going to grow the company will impact the value that the investor gives you. Having defensible IP, know-how, technology, patents, trademarks, copyrights, all that is part of your IP. And then is it a scalable business? So can we, if we continue to put money in, can we really grow this business so that it can really get economies of scale when come in? You don't have to continually add to your expenses and have 100 people doing invoicing. We put together, and I can do this with you if you're interested, just reach out to me. My contact info is at the end of the presentation, but we put together a very high level, simple calculator that we could work with you on, so you can get an idea of what your company might be worth. I mean, this is typically if you've been around for a little bit. If you're a pure startup, it's a different conversation. It's going to be based more on forecasts, but again, we can help you with that, and I can talk you through what that looks like. So, key takeaways, Laura, why don't you up for us?
Just a quick recommendation, because we have 10 minutes left and I see a lot of great questions in the chat.
Yeah.
Why don't we either email the key takeaways in a moment, but why don't we take questions? I think people will get more value out of that.
That's great.
So
So
we
you can
have,
keep this up and people can look at that. But Breen, do you have the questions, or should we go through the chat?
yeah, I've got one here that Breen posted. Thank you for putting the queue out there. Made it a lot easier to identify. How do you recommend early founders strike the right balance between optimism and realism in their financial projections, especially when investor expectations vary so widely? That's part one of the question.
Right. So, Laura, why don't you take a stab at that?
Who, me?
Yeah, Laura.
Okay. How to strike the balance. That's you gave me the hardest question, really, because
you see the hockey sticks all the time, right?
I know. This is what I do. Listen, I think this is really, really hard, because you do not want to, you want to be optimistic about things, and as an advisor, you don't want to smack or crush people's dreams, right? I think the way to kind of balance it is, I always look to numbers in the data. So pulling in someone with Kim's expertise or William's expertise to take a look at what are the numbers telling you, right? And starting from there, that's how I would strike the balance. Because people can, listen, numbers will tell any story you want it to tell, and I can help you with that spin, right? But start with that, and then you will get not to be an optimist, but more about a realist. And right now, with the way the markets are and the economy is, you need to be pragmatic and realistic.
Yes, and I would add to that, I would say the numbers that you put together have to be defensible, right? So
Yes.
You can't just say, oh, I'm going to get 20% of this humongous market. That's just not defensible. So that's a really important, when I look at people's assumptions, I go, well, where'd you come up with this number? Your conversion rate, your close rate. How did you come up with that? Why do you think you're going to close 50% of your sales? That, and if you have a good answer, that's fine. But if you don't have a crisp answer, then you got to scale it back.
Exactly.
Awesome.
Is there,
Thank you.
is there a second part to that one?
Yes, there is. On a related note, beyond the standard KPIs, what are some of the less obvious signals or metrics you've seen investors respond well to, especially in companies still pre-revenue and pre-product or pre-product?
So Kim, do you have a thought on that one?
So the key here is that, especially if you're just in the startup phase, the key things that they're basically looking at, number one is your revenue growth. Number two is your net income growth. If you're in a situation where you're still not cash flow positive, you're still not basically showing positivity on the bottom line, then they're really basically looking to see that that revenue is coming up the chain. And then to William's point, that you have a good explanation as to why you're at where you're at in the stage that you're at. They also wanted to basically take a look at any of that spend is going towards generating then that revenue on top, right? So revenue growth, net income growth are the two key things that basically the base things that they look at. And then from there, you can build out accordingly.
Thank you, Kim. And then a couple more questions here. What are some examples of internal controls was posted by Rose Haft?
So example of that is even something as basic as who can control the cash, right? So what's your policy on who can pay wires, who can pay certain expenses? Do you have just one person doing it, or do you have some oversight? And even putting in a simple solution like a bill.com, where one person is approving the bills and another person's paying them, demonstrates good control. So you don't have to create a lot of these massive processes that like a big company would have, where you have to go through multiple hoops to get anything done. You can put in very basic solutions, but then you just document, I've got bill.com, person A, signs off, person B pays the expense. Now you've created control. And you can demonstrate then to an investor that I understand controls because they're documented, they're solid, they're well thought out. It's really that you've taken the time to think about these things and that you have controls in place so that misappropriation can't happen. Even if you know misappropriation can happen in your business, investors want to see those controls in place and documented. And especially as you get larger, like the company that I mentioned, right? If you're going to get acquired by a big company, they're expecting you to have all of that.
And I'm going to move on to the next question since we're short on time here. Any recommendations for platforms to include in the financial tech stack?
Yeah, there's tons of them. So like, it really depends on what you're trying to do. There's payment platforms like Mercury, Ramp, Brex, things like that. There's invoicing platforms like Maxio and stuff like that. There's ways you can hook in your Shopify, your different, if you're selling product, things like that. So there's so many, there's Carta to basically cover your cap table if you have a lot of investors. So there's so many different pieces of software that you can make a really efficient, well-oiled, scalable tech stack.
That's actually the secret. If someone wants to develop one, because everyone's app fatigue, there's so many different ones. There's one that does most of it, and then Carta does a cap table. So if you can consolidate that.
And somebody just said, what about financial modeling? Financial modeling, you're not going to use tech for. You need a human.
Yeah.
Okay. Because it has to be like, you can't just pop something into a model. It's specific to your business, and that better be specific to your business. If you go to just throw it into some canned product, I don't think it goes too well, because I just did one yesterday at a board meeting. It's intricate, specific, and like the board members want to know like what went into the details. What is it about your business? How does your business function?
Excellent. And then as a startup that is a CPG combined with tech, how would you suggest we make projections since things are changing moment by moment? We want to be realistic, yet we have no idea what margins will be based on the tariff situation, even if paused for 90 days.
So you run it both ways with the
Right.
tariff, without the tariff.
You definitely have a base case, and then best case, and then worst case.
Correct.
And
Worst case would be the massive tariffs, right, that you have to deal with. And then if that was the case, I'd start thinking about maybe sourcing elsewhere or different ways to do things, because I work with a lot of companies who are very creative at avoiding tariffs, you know what I mean, in terms of how you run your product and so forth. So then you start thinking of your backup plan.
Looks like, and then, I mean, a product like Forecaster, Breen, you posted that one.
Yeah, sorry, I was just the not use tech for financial modeling. I just wanted to like double click and just confirm that we're talking about products like Forecaster, like those tools. Kim is kind of recommending against that. I just wanted to I want to make sure that that is the recommendation, because I think a lot of startups in our world are really contemplating this, and they're trying to decide where to put their money. So are these tools, do they make sense as a way for a startup founder to get it started or maintain it? Or should they be hiring a human being to help them do it? I think it's a really important question.
You can use a modeling tool, but even if you use a modeling tool, just from my experience and everything that I do, it's it really needs to be intricate to your business. And the drivers behind it need to be intricate to your business. So typically, most of the time, even if they pop it into a model, they end up getting a human to take a look at it and really customize it to their business.
Right. It's just like the use of AI. You have to have a human in the loop. So while you can use this technology to build it, exactly to Ken's point, it's not going to just take whatever comes out of it. You have to have someone who knows what those numbers are, make sure they know how to defend it. So unfortunately, you're not going to be able to completely outsource your financial forecast or modeling.
So we put together some resources for everybody. So we will distribute a couple of white papers, one, what investors really want or what they're looking for, and two, a capital raise roadmap. So both of these white papers we put together. And then in this deck, there's some resources on the web that you can go after and look at and get some good information about how do I fund my business and what other resources are available for women-owned businesses. So we put this list together for you. And again, we'll distribute the deck following the call.
Well, and just a shout out to all the male founders out there. Don't worry, we see you too. Not only women founders here, but women founders, as all the stats showed us, we need all the help we can get. I mean, we all need all the help we can get, but just wanted to qualify that.
But the same points apply. The same points apply about making your numbers
100%.
defensible, having knowing how you're going to spend the capital that you're asking for, telling your story, making it defensible. That all applies, as well as the key takeaway, which is know when to ask for help. Don't wait to ask for help. There's so many people that want to do that. You can work with the Fourth Effect, engage advisors, contact William and Kim, talk to one another, right? The pain is common and it's real. So I think that's the key.
I have all my contact information in here. You can book a call, you can call me, you can email me, whatever you need. I'm available for any kind of help you might need, or just have some questions following this webinar. So thank you all. Thank you, Breen and Kat, for putting this together.
Oh, you're welcome. And also, CEO Right Hand is our partner. So inside the platform, you can find their profile and preferred partners, and you can access them that way straight through the platform. So yeah, and more to come. Can't wait for part 2 and part 3 and those white papers, which we will circulate.
Amazing.